Hello everyone and welcome to the Well-Built Environment Forum webinar series. My name is Tarrant Parsons. I'll be your moderator for today's session, during which we'll be discussing the latest results of the RICS Global Commercial Property Monitor. So this is referring to the first quarter of this year. And of course, during this session, we will be paying special attention to the feedback received across Asia Pacific, as well as the Middle East and Africa. Just to give you a bit of an overview of the structure of today's webinar, for the opening 20 minutes or so, I'll be running through some of the highlights coming from the Q1 survey results. This will then be followed by a deeper discussion with our panelists, talking through some of the key trends emerging across commercial real estate and how these could unfold going forward. So I'd like now to introduce you to our panelists, who will be providing their expert views on the commercial property market a little bit later. So we have three panelists joining us today. So firstly, I'd like to welcome Dr. Chua Young Liang, who is Head of Group Research and Analytics at ARA Asset Management. So he's responsible for monitoring economies and property markets across Asia Pacific and providing strategic data analytics to the firm. So prior to joining ARA, he led the Southeast Asia research teams at JLL for over 10 years, and his responsibilities included forecasting property markets, conducting market and development advisory, and providing commentaries to clients and the media on matters relating to property and urban policy issues. He began his career in physical and strategic planning at the Urban Redevelopment Authority in Singapore. So Young holds a Bachelor of Science in Estate Management from the National University of Singapore and has a Master's in City Planning, as well as a doctorate from the University of Pennsylvania in the United States. He's also an adjunct researcher with the Centre for Livable Cities within the Ministry of National Development. So, hello, Yang. Great to have you with us today.
Hi, Tarrant. Good to be here. Hi, everybody.
So we also have Sasanka Lianage on the panel today, who is the Head of Research at Charter Hall. So he's responsible for the group's research requirements across transactions, investor relations, reporting and product development. So prior to joining Charter Hall in 2018, he was the head of industrial research at JLL, where he provided advice to external clients, the national investment teams, and authored research publications. Sasanka has also previously worked at Colliers International and the Wynnum Group, where he participated in key projects for major institutions and private equity funds. He holds a Bachelor of Economics and a Master's of Property Development. So hello, Sasanka. Thank you for joining us today.
Hi, Tarrant. Thanks for having me. Hello, everybody.
And then finally, may I introduce Rosanna Tang, who is Head of Research and Senior Director for Hong Kong and the Greater Bay Area at Colliers, having joined in 2019, has recently been promoted to Senior Director. So with 15 years research experience, Rosanna has a deep understanding of all property sectors, research products and client requirements. Prior to joining Colliers, she worked in the Corporate Planning and Strategic Investment Department of Sun Hung Kai Properties, where she led and contributed to research analysis for Hong Kong and overseas property markets. So prior to this, she was with CBRE in their Hong Kong and Asia Pacific research teams, where she led numerous research papers and client-oriented initiatives. So Rosanna graduated from Peking University with a Bachelor of Law degree, majoring in political and public administration, with a double degree in sociology. She then went on to earn a Master's of Science in Finance from the University of Michigan. So hello, Rosanna, great to have you with us today.
Hello, everyone. Thanks for having me here today.
Great. So as always, we do welcome active involvement from the audience. So if you do have any questions as we go along, please submit these to our panel, as it really does help bring the conversation to life. If you're new to these webinars, you should see that you can submit questions at any time using the question box on your screen, and we'll try to pick up as many as we can as we go through the session. So with all the introductions done, let us move on to look at the latest survey results. But just before I go into that, perhaps for the benefit of you who may be unfamiliar with the output of the survey, I just want to quickly go through some of the background methodology. So the Global Commercial Property Monitor is conducted on a quarterly basis, and it is a sentiment survey that tracks changes in conditions across global commercial property markets. The data can be displayed at regional, national and subnational or city levels. In latest survey period, so Q1 of this year, there were more than 2,700 unique responses, and these were gathered between the 10th of March and the 12th of April. In this context, commercial property is indicative of income-producing property only. In order to compile the global and regional averages, the data is weighted using estimates of the investable commercial real estate universe. Those estimates are produced by LaSalle Investment Management. A lot of the indicators, but not all of them, but a lot of them are based on net balances. And this is the preferred method for measuring sentiment and is simply produced by subtracting the percentage of contributors who respond negatively to a question away from those who responded positively. So here's an example just to clarify that. If the question was, say, how have prices changed in your area during the last 3 months? If 30% of the respondents said prices have risen, while an equal 30% of the survey sample reported no change, and then the remaining 40% responded that they had seen a fall in house prices, the end result would be a net balance reading of -10%. And so this net balance data has the benefit of being easily comparable across geographies and has a great track record in providing a leading indication of the future direction of travel for key real estate market metrics. So with all that being said, let us move on now to discuss the latest findings. I think if we start by looking at top level aggregate trends in sentiment, here we have the headline RICS commercial property sentiment indices, and these are an amalgamation, a combination of our results for several key variables covering, for instance, changes in demand and supply, as well as rental and capital value growth expectations. And these are broken down by world region. You can see that both at the global level and across all broad regional aggregates, there was a further improvement in sentiment over the quarter, but I would still emphasize that the latest readings do remain negative, and looking back over the whole period shown there on the graph, these latest figures are still on the weaker side when placed in a historical context. But nevertheless, there are still some signs of improvement, and to give you some reference regarding the magnitude of this improvement, the global average sentiment index hit a low of -37 back in Q2 last year and has gradually turned less negative to reach -18 in the latest results. Although there isn't a dramatic difference across world regions, Asia Pacific has seen probably the most noteworthy pickup so far, with the headline index moving from a low of -38 to now stand at -15. If you look at the other end of the scale, the Middle East and Africa, aggregation there has been slightly slower to retrace the ground lost early last year, as the index hit a low of -39 in Q2 and now stands at -22 in the Q1 results. And then just rounding off the information on that graph, you can see the latest readings for Europe and the Americas are sandwiched between the two. So if we move on now to look at perceptions on the current phase of the property cycle, here we also see feedback turning in a slightly more positive direction. So the purple bars show the share of respondents that now feel the market has entered the early stages of an upturn or recovery. And if you compare this to the turquoise bars, you can see that this share has risen compared to Q4 last year across all world regions. Again, the most noticeable improvement regarding these perceptions can be seen in Asia Pacific, where over 1/3 of our respondents now feel a recovery is underway, and that's up from just 18% previously. While the Middle East and Africa hasn't seen or didn't see too much movement between Q4 last year and Q1 this year, the share currently sensing that the market is in the kind of early stage of an upturn is at 28%, which is slightly above the global average and quite significantly higher than Europe, which stands at just 18%. Of course, I would just emphasize that although the trends that's seen in the latest quarter certainly are more positive compared to last year, if you think about the reverse of these figures here, it does mean that these percentages are still outweighed by the share of respondents that feel their local market is, for the time being, still turning down, or perhaps has reached a floor but has yet to kind of convincingly turn upwards. So while I have highlighted the more positive aspects of the data, there is still a lot of caution out there regarding the phase of the property cycle. So we turn now to look at the survey's measures of demand. This next graph perhaps provides the reason as to why there is still a lot of caution. So just to explain, each bar in its entirety is showing the global net balance of occupier or investor demand, and then the separate colours are indicating how much each region is contributing to that negative global reading. And so as a result, our occupier demand indicator, it does remain very much negative, albeit less so than in Q4, but it is still negative across all regions, with especially downbeat readings coming from Europe and the Americas. You'll notice though that the picture is actually quite different on the investment side, and the global reading for investment inquiries is only marginally negative now, and moving towards neutral territory, which we would say indicates a much more stable backdrop in comparison to the occupier side. So clearly the occupier market is lagging behind at this stage, and I feel occupier market trends are a slightly more accurate or fuller reflection of the economic challenges faced by businesses, or many businesses right now, amid the global pandemic. Obviously, we're talking in aggregate terms here, and individual experiences may differ, but I think the investment market can sometimes just feel a little bit disconnected from the economic climate. It's more immediately, or can be more immediately, influenced by changes or loosening in monetary policy from central banks. So that would be my view as to why we have this divergence. And of course, if we move on now, there is the issue that these headline averages mask significant differences between each of the mainstream sectors that are covered by the monitor. And as this next chart here shows, trends across the industrial or logistics sector are incredibly strong, or they stand in complete contrast with the headline view that I've talked through up until now. And at the global level, our survey results are actually pointing to some of the strongest growth in tenant demand for industrial space since our global survey was established in 2008. I know in Europe, our industrial occupier demand indicator returned the strongest reading that we have on record. It's not quite as elevated in comparison across Asia Pacific, but still solid demand growth is being reported for industrials. What's really pulling down the all property averages, as demonstrated by the purple and red lines here, is the weakness being reported across the office and resale sectors, which does remain significant, even if the latest readings have improved somewhat following the lows hit during the first wave of the pandemic last year. So of course, it is largely structural factors, or you could argue it's structural factors that are impacting these two sectors that are likely to continue to have a bearing for some time to come. Obviously, the rise in online shopping at the expense of in-store spending for retail isn't a new story, but it has been accelerated dramatically by recent events, while the increased prevalence of remote working, I think sparked initially by the pandemic, but now expected to be adopted longer term, is causing a shake-up in the office sector. So if we move on now to look more specifically at what may lie ahead for the office sector, an additional question was included in the Q1 survey, which gathered expectations on the degree to which businesses may look to scale back their office footprints over the next 2 years. And so the results are displayed here for you. And on average across the globe, our survey participants are expecting office space requirements could be trimmed by around 9% if we round up there. We did in fact ask this same question 6 months ago, and the average back then was pointing to an 8% reduction. So obviously that's a pretty similar result over the two periods, but it just hints that the expected reduction in office footprints is very slightly larger now than previously anticipated. What is interesting though is that expectations move slightly in the other direction across Asia Pacific and the Middle East and Africa, with estimates now standing at around 6% and 7% respectively across those two regions. Obviously, there are a wide range of views on this, and we're only talking about the average of that feedback, but it is interesting that the expected reduction is much larger in Europe and the Americas. And if we drill a little bit deeper into the data, it shows respondents in France, the United Kingdom and the United States are expecting amongst the largest scaling back in office footprints from businesses over the next 2 years compared to all other countries at around 12 to 14%. But overall, even if we saw, say, a decline of 6% as our respondents project in Asia Pacific, that is still pretty significant, and new working preferences really are set to shape how office space is utilised going forward, it would appear. So moving on to another extra question that was included in the Q1 survey. This one asked respondents for their view on how long it could be before revenues generated by each asset class return to pre-COVID levels. So if we look at the global picture to begin with, respondents felt that revenues generated by shopping centres would take the longest time to recover on a sectoral comparison, and that could take another 3.5 years from this point. In terms of the other sectors, respondents also foresee a relatively lengthy recovery time of 3 or more years to return to pre-COVID levels for secondary offices, which based on this feedback may feel the brunt of the reduction in footprints. High street retail and hotels also display a similar expected recovery time, with business travel seen as being hit slightly more severely than leisure. And then at the other end of the scale, industrial and logistics assets were seen as recovering in less than a year. And I think in many cases, they could have already bounced back from the initial hit right at the beginning of the global pandemic. With regards to some of the kind of broad regional trends, and there are some notable differences here actually. In general, expected recovery periods were shorter in Asia Pacific compared to all other world regions. That's across virtually all sectors. I think shopping centres in particular are expected to prove more resilient across Asia Pacific, taking just over 2 years to bounce back. If you look at Europe, respondents expect particularly protracted or drawn out recovery for shopping centres, taking up to 4 years or more. I think another interesting distinction is that views on industrial and logistics are not quite as kind of exuberant in the Middle East and Africa as they are elsewhere across the world, and it's actually expected to take a couple of years for them to recover to pre-COVID levels. So if we turn now to focus on the outlook for capital values across various market segments, as you would imagine, expectations are kind of extremely varied at this sector level. So leading the way, prime industrial capital values are expected to see the firmest growth at the global level, although projections are a little bit more modest when disaggregated across Asia Pacific and MEA. Capital values also display, say, a very firmly positive outlook for data centers, a sector which I haven't mentioned up until now, but is an area which sits under the alternatives label that seems to be expanding at a very solid rate. Our respondents also returned a positive assessment for capital values over the coming 12 months across multifamily residential and aged care facilities. That's at the global level. All remaining sectors displayed there are expected to post declines in valuations in the year ahead when viewed in terms of the worldwide averages, with secondary retail and hotels anticipated to see the steepest declines. But you will notice there that expectations across Asia Pacific and the Middle East and Africa are, generally speaking, much less downbeat than the global averages for most of those categories. And then lastly, one final chart I'd like to share with you before we move on to the panel discussion shows a breakdown of our investment demand indicator across the cities that we cover throughout both APAC and MEA. So within these regional groupings, there is a high degree of disparity between the strongest and weakest performers, and I think this graph kind of illustrates that quite succinctly. So just to clarify, the horizontal axis is referring to the overall investment demand metric from the survey, while that vertical axis depicts readings for international or foreign investment inquiries. So these are not absolute levels of demand, they're a better reflection of growth rates or momentum. So a few markets stand out there as seeing an increase in both total and international investment demand during Q1, and those would be Shanghai, Tokyo, and Beijing. I think in each case, there has been a noticeable turnaround in the survey results over the past quarter. Investor demand is also picking up in Auckland, and it's largely stable in some of the Australian cities that we cover there, even if foreign investor demand, according to the survey feedback, has yet to kind of fully turn a corner. On the other hand, we have momentum remaining pretty subdued, to be honest, across Abu Dhabi, Kuala Lumpur, Hong Kong, and Dubai, among others. But what I would say is that virtually everywhere across the region, the latest feedback is to some degree less downbeat than it was in the previous quarter. And if trends were to progress in the same manner, so moving in the same direction over the coming quarters, we should see more markets shifting into that stronger performing top right hand quadrant. But as it stands, and I think quite understandably given still significant challenges posed by the pandemic, there is still a lot of caution evident. So kind of that covers all of the aspects of the latest survey results that I'd wish to go through today. If you have any questions on any of that, please do submit these and I'll be sure to pick them up later. In the meantime, could I now please go to our panelists? I think one of the key themes coming through in our survey results this quarter would be that there was a rising share of respondents sensing that the market had entered the early stages of an upturn, even if this share was still outweighed by those with a more negative view. But I'd be interested to find out, what stage of the property cycle our panelists see the market at. Obviously, please feel free to separate out the sectors. It may be difficult in truth to apply a single layer label to cover all of them. Sasanka, could you please please come to you to start us off with that one?
Yeah, sure. Thanks, Tarrant, and thanks for that presentation. I guess looking at the presentation and having talked to some of the panelists just before we joined the call, we've been pretty lucky in Australia because we're a bit earlier in the recovery path, in the sense that the economy opened up a lot earlier than many of the nations overseas, given that we were able to suppress the actual pandemic and ease some of those restrictions. So if it's anything promising, I would argue that the recovery, I was quite surprised by some of those results, because what we're seeing here is a little different. And I guess that varies by sector, and probably the easiest sector to answer is probably the industrial sector. It certainly contains all the ingredients for a continued upswing, which has obviously emerged across some of those indicators in the early stages. This sentiment is unsurprising in Australia. Just over the past month, we just saw the largest direct commercial real estate transaction to date. The Milestone Industrial portfolio sold for around $3.8 billion. So that brought our first quarter industrial transaction volumes to around $5 billion. So from an investor perspective, that's the type of volumes we would typically see over a year. If we add up all the bidders that participated in that transaction, there was around $45 billion worth of capital looking to get set in Australian industrial. So transaction evidence from that transaction and some of the other transactions that we've seen so far in the first quarter point towards a re-rating and further cap rate compression across the Australian industrial market. But from what we've seen from an occupier perspective, is something that we've seen overseas happening for a while, and it's been accelerating over recent years. But over the past 12 months, we reached record leasing volumes across Australia's industrial sector. That's as high as we've ever seen it. And online retail spending jumped forward 4 to 6 years because of what happened during the lockdowns. But we believe e-commerce penetration rates will continue to lift further, given some of the larger groups, some of the larger retail players are yet to flex up here. The challenge that we're facing at the moment is how to sustainably deliver the industrial space that's required, given the limitations of development stock that we've had, and given the sheer volume of occupier activity that we're seeing. It's going to be a challenging task to find that industrial space which meets the demand. So we anticipate that there will be continued growth or escalation in rents over the coming years. For the office sector, the occupier side of things looks to be stabilizing, and that's probably what's moved the most. From a value perspective, it didn't move too much over the past year. A lack of assets were placed for sale, given the broader uncertainty that drove the diverged expectations between vendors and buyers, which limited transaction activity. However, transaction evidence suggested that valuations remained relatively firm. Prime assets with durable income streams were sold at book value or premiums to book values, whereas investors were less tolerant if an asset had upcoming vacancy. So those assets which transacted and came to market sold at some discounting. headline vacancy levels across the market have been inflated given the quantum of sublease vacancy out there in the market. But much of this sublease vacancy was introduced in the second half of last year, where there was a very different trajectory to forward growth. Since then, the economy and conditions have strengthened quite a fair bit. I mean, our economic results have been quite ahead of forecast. And the labor market as it sits, our unemployment level is at a level we didn't think we'd get to until the second half of next year. So it's broadly in line with pre-pandemic levels over here. So given these upgrades to economic projections, the improved business conditions and the quicker return to offices that we've seen over here, much of this sublease vacancy is now starting to get leased up, withdrawn or retracted from the market. Now, performances across the retail sector is a bit more diverged. That grocery anchored and convenience anchored retail sectors have performed quite well over the year and continue to do so. However, those larger discretionary retail centers and those medium-sized centers are still challenged by that social mandated restrictions and the travel restrictions, which have really limited the inbound tourism and the inbound or the inflow of international students as well. But looking at it at a headline level, retail spending was actually quite solid over the past year. And given the amount of time spent within homes, Australians chose to upgrade their homes and spend a bit more time in improving their homes and setting up for remote working. And so household consumption was actually quite strong last year. We're now very much into a residential upswing over here. So this should continue to support hardware and large format retailing across the retail sector, but the retail sector is a bit more diverged.
Thank you very much for that, Sasank. It certainly seems as if there's a stronger recovery coming through in Australia, and I'm sure you're right in the sense that, you know, when the economy could open, the earlier they could open, the earlier recovery is enabled in the commercial property market. So, Young, what do you see in terms of or your perceptions on where we are in your markets or in the property cycle?
Yeah, not very dissimilar to what the RICS results have shown. I think what we look at is across Asia Pac and found that there's a distinct difference in terms of the asset classes, the office, retail versus the industrial. To me, the industrial sectors across Asia Pac, they seem to be more concentrated. They're all about the same time, in kind of like a peak of the cycle. Whereas when you look at the office and retail segments, they are dotted all over the property cycles, especially with the core cities, the first tier cities, Australia and China and Singapore and Hong Kong. They are mostly towards the end of the correction, nearing the trough, I believe. Especially with the social distancing measures being lifted across all these cities, we can expect some kind of recovery. Of course, depending very much on the local market demand and supply. Whereas in the industrial side, as I mentioned, they seem to be all kind of aggregating towards the peak of the cycle, and I think that's because of where things have been, or that e-commerce and demand consumption rising on the back of e-commerce's and technological advances has spurred a lot of demand for industrial spaces. So it's not very dissimilar to what you have seen, but overall, in terms of the details, really that's where the devil is right now.
Great, thank you very much. And could I turn to you now, Rosanna?
Yeah, sure. I think for Hong Kong, before I touch on the key commercial sector cycle, let's zoom out slightly and have a look at the macro layer of the market here. Because actually for Hong Kong, the case is slightly special. We have seen we've been facing the ongoing challenges actually since the second half of 2018, when the weakness stemming from the US-China trade tensions started to emerge. And then we further have a series of local protests in Hong Kong during 2019. And then last year, of course, we had the outbreak of the COVID as well. And all these have actually piled up the economic impact and increasingly weakened the market momentum, no matter from the leasing or from the investment funds. But however, we do believe the worst time for Hong Kong may probably have already passed us last year. And while we started to see some emerging signal of slight improvement in the market. And for example, for the macro side, we started to see some recovery of GDP figures. The latest figures in Q1 shows that the 18-month recession in Hong Kong will likely come to an end with a GDP growth of 7.8 on a year-on-year basis in Q1, which is a fascinating figure after a revised 2.8% decline recorded last year in Q4. And to look back the historical cycle, actually most property sector is highly correlated with the Hong Kong's economic performance. And for instance, we saw that for office sectors, performance is highly correlated with the GDP, and while our logistics sector is highly correlated with the trading figures and export figures. So now with the better than expected result recorded in the first quarter, I think it's definitely bring for a breath of fresh air in the market. So back to the cycle for commercial property, as we mentioned earlier, we do believe the worst time should have gone. But for office sector, we do expect to see more consolidation actions from the corporates during the first half of the year, especially now when most of the COVID restrictions is still remain in place, which makes the business travel remain very limited in the city. And at the same time, vacancy rate rise to a recent new high at double digit as well. So we do believe office rents and price will remain under pressure at least in the first half of 2020 before it's gonna bottoming out, and followed by a more stable second half before it's going to rebound or recover from 2022 onwards. And for logistics, as we mentioned earlier, Hong Kong's total export has been rebounded quite significantly. Actually, in first quarter, it rebounded by 33% on a year-on-year basis, which is a very fascinating figure again. We've already started to see some logistics property prices slightly rebounded by around 2% range in the first quarter. And we do believe industrial sector, as you highlighted also in your slides before, it will stand out as one of the most, or stand out to be the first commercial sector to recover and regain momentum compared to office and retail. And for retail, we do think that it's more like a year of stabilization for this sector. And in fact, after dropping by over 70% from its peak in terms of the high street rents, we observed that for the first quarter's figure, high street rent is staying relatively flat compared to the last quarter, which is also a good news pointing towards more stabilization in terms of retail rents in the city. But I think local consumption is still the most key important thing. Meanwhile, as well as the near-term outlook for retail trade, it could be still challenging because the timeline of the partial recovery of inbound tourism, this timeline is still remain uncertain.
Thank you for that, Rosanna. So yeah, clearly wide kind of divergence in the sector trends you talked about, we've heard from everyone there. So with that in mind, do you think the relative strength in the industrial sector compared to office and retail is going to turn into the new normal? And if you don't think that's the case, how much longer do you expect this to last? And what kind of future do you see for the retail sector, given the extent of its decline in some areas? Young, could you perhaps kick us off with that one?
Yep, sure, Taryn. I think there's something more structural that's going on here. And by that, I think everybody understands there's been a structural change, a shift in the concept of retailing. The transactional experience that we have seen in physical store that we're so used to has been somewhat diluted by the emergence of online payments and direct delivery of merchandises, our doorsteps. And this shift to me is not going to be temporary, it's more permanent, especially with a new breed of millennial consumers coming on board. There will be greater convergence of these two markets, that is retail and industrial. And we're going to see a lot of that repositioning of retail, the blurring of lines between what is retail, what is industrial production, deliveries, as well as last mile logistics. That's going to kind of, that separation is going to blur, and depends very much on the local planning dimensions and regimes. Office, on the other hand, to me, is a latecomer to this technological shift. This shift I meant is really driven by technology. If you look at it, the whole retail consumptions, the e-commerce is really very much driven by the emergence of the internet. So this technological shift has office players a little bit slower to the game. The disruption that we have seen so far really has been accelerated by the pandemic, out of necessity, really. This shift, while permanent, is not as adverse as we have seen in the brick and mortar retail space, but a lot more complementary. And why is that so? To me, I think there are essentially there are two things. Office still remain relevant in the bigger scheme of things on two grounds. First, the recent social lockdown showed to us that employees still need a place to meet, to discuss, and to collaborate with their colleagues. The digital conferences that we're also used to do help us, right? Do help us to meet up with colleagues, but it's not as effective for reading body languages or subtle cues. Somehow the office function will shift towards more of a venue for collaborative and communicative work, while the alternative spaces such as working from home, co-working, and decentralized offices will fulfill the individual work time. That is the downtime where we need to have solitude to start thinking, strategize, write our papers, and whatnot. And two, the technological support that made alternative work solutions possible, they need a place too. And increasingly, I've seen a lot of these new IT firms moving into central CBDs or even just suburban offices. So they do need a place to operate as well. So on that on that two reasons, I think the transformation net effect is not as adverse as we have seen in the retail space. And I think it's still likely to remain relevant in the years ahead.
Thank you for that, Young. Sangha, could I come to you now? What do you see in terms of the future for retail?
Yeah, I guess coming back to the ordering of the various sectors, I agree with Dr. Chua over there. Not sure how to classify the new normal, but over the near term, it's difficult to see an environment in which a reordering occurs. I think the structural forces affecting the retail and industrial sector are more evident, and so the continued adjustment between those two sectors will likely continue over the foreseeable future. The office equation is a bit tougher in my mind because I feel some of the cyclical impacts have been misrepresented as structural issues. So I don't think anyone can definitively claim that there won't be a reversion back to longer term trends. I mean, coming to the office and continuing on with the office, I think in many ways this was a forced experiment, which forced the acceptance of workplace flexibility, but at the same time raised awareness to the actual purpose of the office. In Australia, we're yet to see any evidence of the structural change, and I would argue it's a bit too early. What we are hearing and seeing in a lot of surveys is that amongst senior leaders is a growing concern about cultural decay and maintaining social capital. There has also been increased reports and surveys from employees stuck in remote working environments facing the increased mental health challenges, working longer hours and missing the social interaction with their colleagues. So I think, if we think about the contributions of informal interactions, access to leaders, the storage and transmission mechanisms of social capital provided by an office, then we start to understand that the impacts to innovation and productivity and collaboration and onboarding. So these hurdles will need to be overcome before we could arguably see a structural reduction in office demand. But having said all this, the counter argument to this is there has been large investments towards improving home offices and the support and technological infrastructure. So remote working has become easier and more prevalent than ever before. But the impacts on real estate, or more specifically, how much floor space you require, will ultimately rely on how much flexibility is offered to your employees, how many fixed days they have off, how much buffer space we require, how we deal with project times and getting people back into offices during the allocated work from home days. And I think the one additional thing that I would bring to this structural changes in office equation is that there will probably be an easing of office densities now. Companies will evaluate the probabilities of future health-related disruptions and the impacts of their business. So I think the days of cramming people into offices and those really high densities are past us.
Thank you very much, Senka. So, Rosanna, have you got anything to add on the kind of the relative outperformance of industrials over the other two kind of mainstream sectors, and whether you expect this to continue?
Yes, indeed, we do. Well, as I mentioned earlier, I do believe that among office, retail, and industrial sector, industrial sector should gather its recovery momentum faster compared to the other two. And as the two gentlemen highlighted earlier on, the COVID pandemic had changed the way of how people work, live, and commute. And this definitely has increased the demand for like e-commerce and more leverages on technology for work. And hence, recently we do see the market inquiry has been increasing on data centers, cold storages, and we do believe that's part of the structural change that we may see in the market in Hong Kong after all. But however, I think for some of the other sectors like office or retail, we may not be seeing, like as compared to the other cities, those kind of structural change in terms of space requirement, because we are very densely populated city and a first most city. And I think the road of recovery for retail will be very much depending on, well, really about the control of pandemic and the external factor. And because as you all know, Hong Kong is a very tourist-oriented city, and actually over 40% of the city's retail sales are contributed by the tourists. So I think eventually it will definitely take some time for the global trade or travel to be fully resumed. But at the same time, we're also relying on mainly relying on local consumption, where actually we are seeing the performance of some of those kind of neighborhood malls, those shops around the new town area, neighborhood area are still holding up fairly well in the city. So I think this is also one of the key things that I want to highlight.
Great, thank you, Rosanna. So yeah, I'm not sure all of you are quite as negative on retail. The future of it is what it seems to be here in the UK. I know shopping centres, the trouble there with vacancies and everything, it far predates the global pandemic, and this is just really kind of it's exacerbated that trend. But it's interesting to hear your views on that. If we go to look more specifically at the office sector, then so you've all heard the results from the survey, which show roughly speaking, our respondents expect a near 10% reduction in office footprints from globally. Does that figure seem reasonable to you, or how do you see any potential structural reductions in occupiers' required office space going forward? And do you think more occupiers could choose to sublease space in the near term? And if there are any specific industries or regions that you perhaps see as being more prone to having office space requirements reduced, that would be very interesting to hear. Sanka, could you kick us off with that, please?
I was quite surprised by those results. That said, when we started doing these surveys in the middle of last year, when we were all in lockdowns, that was very much the case. We were getting those surveys results come in, and they've moderated on every iteration that we've had here, and with a lot of the surveys that we've talked through here. I guess I've already talked about the contributions that an office has to productivity and all that stuff, but what we're seeing in the office sector here, having come out of the lockdown, is we're having we're having occupiers, our tenant customers, trying to get everybody back into an office, and that's what we've seen. And when we talk about the tenant demand and the occupier take up, our leasing agents and tenant reps have been busier than ever. so we've had inquiries jump significantly, and the occupancy has just moved with the capacity of the buildings, really. That's been determined by the mandated restrictions. From an occupier perspective, though, across the office sector, it's been diverged. I mean, typically during an economic downturn, you see a flight to quality. You see occupiers look to capitalize on market conditions by upgrading their premises. But this was a health-led pandemic, which has amplified that divergence between the prime and secondary sector. So priorities towards asset attributes like better internal environments, air quality, building management, hygiene standards are at a higher standard in prime grade assets or better quality assets. So what we've seen is higher occupancy rates, deeper tenant demand, and firmer leasing results for the better quality buildings. What we're seeing over here in Australia is that, and what we're very cognizant of, is that there is a bit of a development cycle going on here, and this is led by Sydney and Melbourne because of the shortage of development that took place over the past 5 years. So we're making up for lost time in terms of development. And so a lot of these buildings were commenced before the pandemic took place. So although we've seen this material strengthening of the leasing environment over the past 2 months, it will still be a competitive leasing environment over the near term, and we believe this will create some material and significant challenges for the older and poorer quality assets.
Thank you, Sasanka. Rosanna, could I come to you now? Does that kind of 10% expected reduction, I know it's a bit smaller across Asia Pacific, but does that sound kind of reasonable to you, or what would you expect?
Actually, I do think that the work from home impact would differ in different cities. Like as I mentioned, in a densely populated city like Hong Kong, travel distance is actually relatively short, and the commuting time from home to office is usually within an hour for most of the people. And at the same time, you also may be aware that the residential home unit is very small in Hong Kong as well. And literally, we have been hearing from our clients that they're saying that, oh, maybe it's too crowded to actually work from home for a prolonged period of time. And it's actually not quite practical for most of our clients to work from home on the fully basis. So and also, I think secondly, is also because of the COVID situation, it also makes an alert for some of the corporate to really rethink their corporate policy in terms of the density in the office, and even though the total number of staffs in the office could be reduced because of the work from home practice. However, this impact could be actually net balanced off by the requirement of really to spacing out the staff within the office environment. So basically, in short, we do think that yes, there may be some companies looking to downsize part of this office space in Hong Kong, but instead of it's solely because of the work from home exercise, we do think that it's a combination of impacts from the economic side, as well as the work from home exercise as well. And actually, what we observe in the office sector is that nowadays, because of the high vacancy, some of the MNCs are, of course, looking to downsize their space at the moment. But those MNCs are also the company expanded the most when the economy is doing good. And of course, they downsize the most when the economy is doing bad. Whereas nowadays, I think for most occupiers in the grey office sector, cost saving remain the key themes. We won't be surprised to see there would be some ongoing relocation moves. But I think, yeah, this is really hard to segregate. Is because of the economy or is because of the work from home structural change.
Okay, interesting. Thank you. Thank you for that, Rosanna. And Young, anything to add on that question around office space reductions? I think we might have lost Young there, if he's on mute, perhaps.
Sorry, Sorry, I couldn't hear you. That was disconnected for a moment there. Sorry.
Apologies. I was just saying asking if you had anything to add on, that expected 10% reduction in office footprints, if you tend to agree with that, or whether you have a slightly different view.
Right, sure. Well, I must admittedly, I was a little bit taken aback by that percentage. I'm not saying that we're not seeing any contraction, but I believe there will be some further downside risk to the market of occupancy going ahead, especially considering that firms are still adjusting to the new work style. We did our own survey of our tenants across China, Singapore, and Australia, and I found that there's some kind of a distinct difference in terms of the occupier trends and strategies that are adopting. This is the first time you're going to hear this because we just finished the survey and it's yet to be released to the public. But enough to say, just generally speaking, I found that markets that are ahead in terms of controlling for the pandemic were definitely ahead. They are a lot more confident, and in terms of occupier trends are very different. In China, for example, the concept of working from office is very, very strong, and most occupiers require staff to be back in the office, and that could possibly because they will manage to contain the virus a lot faster than the rest of the regions here. But having said that, when you look at Australia and Singapore, the trend is a little slightly different. The concept of working from home is a lot of flexible work arrangements. It's a lot more accepted in general sense, and we do expect some further possible adjustments in the space take-up in places like Australia. Whereas in Singapore, I think most occupiers that we spoke to are not making any adverse changes to their footprint. What they may do is probably adjust the way they use their space internally, but they're not looking at downsizing their spaces as yet at this point. So I think that it depends very much on the maturity of the market, where they are in terms of how alternative works solutions are being accepted in the local culture. I think that would probably. So your overall numbers was a bit of a wow, 10%. That's quite huge. I'm not seeing that across our assets, at least at this point in time.
Okay, thank you for that, Young. I should say that although I didn't share it with you on the slides, actually China did come out at the very kind of bottom with the smallest reduction in office footprints expected. So that would kind of go along with your observations there. I think we've just got time for one more question. So lastly, if we could just turn to focus on some alternative commercial real estate sectors now. Data centers, as I mentioned earlier, stand out in our results as displaying particularly solid expectations for capital value and rental growth. So, are there any sectors that you would perhaps like to highlight outside of the mainstream industrial that you feel have relatively strong growth potential over the next few years? Rosanna, could I come to you there?
Sure, I think I'm with you on, well, we just mentioned data center and cold storage. And that's back to the fact that again, the COVID has changed the way of how people live again. And we have seen on the ground an increasing investment appetite for these logistics subsector, i.e. the cold storages and data centers. Of course, these are all supported by other longer term macro drivers, including the growing 5G network, cloud computing, e-commerce, and F&B demand. And in fact, we just look at the recent number, the retained imported frozen food for Hong Kong has increased by 49% over the last 3 years. And while the online retail sales also expanded by over 60% in the first quarter in the city. So these kind of underlying demand and data also tell the case that why we do see this substantial growth of investment demand in, for example, cold storage sector. And we do see that investors tapping into these subsector is because of some of them are looking for long-term income streams, because nowadays we've been hearing from the ground that doing the value add opportunities investment angle is slightly difficult because there are not much stock that could play by that angle. While there are certain requirements, of course, of special skill set and technological knowledge for running and operating data center and cold storages. So this also reflected in the cap rate of these two subsectors, which actually exhibits a higher yield band between around 3.1% to 3.8%. Which is quite impressive as compared to the other traditional assets like office or retail, where our cap rate in the city is tracking around or below 2.5%. So compared to the other retail and office sector, industrial properties and of course cold storages and data centers actually demonstrated a higher level of resilience and stabilities in terms of rents and capital values performance, even when we were in COVID last year. For example, when office and retail are correcting by over 20% from their peak, I think because of the COVID, I think industrial sector is only corrected by around a single digit over the last years. So meanwhile, we also have the policy support, for example, the Industrial Revitalization Scheme 2.0 announced by the government to trigger the investors to do the redevelopment opportunities. And some of the investors are also eyeing on the relaxed plot ratio restriction so as to improve their return on investment to build higher floor area ratios. So we do believe that all these schemes and policies will also back the demand for data centers and cold storages, and they will remain the hot pick for investors looking for opportunity in Hong Kong meanwhile. And in fact, even for the land sales, it also demonstrated that the price for industrial sites has expanded for over 4 to 6 times over the last decade, especially for those eligible to build data center facilities.
Thank you for that, Rosanna. And Sasanka, do you have any views on fast-growing alternative sectors in the areas you are?
Yeah, I guess the alternatives universe is quite diverse and covers a range of sectors. And broadly speaking, they're all supported by longer-term macroeconomic and demographic trends. And we've had a fair bit of weight of capital looking for portfolio diversification. So they've been chasing a lot of these subsectors. But you know, one of the key features, and especially over the past year, was that they don't typically follow your normal economic cycle. And there are some which stand out, but COVID-19 really accelerated the demand for some of these, particularly for those in the healthcare, the biotech industry, and data centers, as we've discussed. But overseas, we've seen the life sciences and the pharma companies expanding quite rapidly, and we're seeing that start to happen over here in some of our suburban markets. The continued demand for data storage capacity is pretty well understood. I mean, I've been surprised by some of the reports that are coming across my desk. Some of them saying the data infrastructure requirements could grow by 40x by 2030. So, I mean, the data center operators adapted quite well over the past year. They moved into some of our industrial markets and some of our suburban markets, and consequently, they pushed up land values and some rents in those markets. One of the sectors that Charter Hall is quite active in is the childcare sector, and that again showed some robust performance over the past year and will play an integral part and important role in getting everybody back to work. And the final alternative sector that I'll probably touch on is the BTR sector, because that's been getting a lot of commentary as well over here. It's got many demographic and structural trends that are moving in its favor. But the probably for there to be a very quick acceleration or an uptick in the sector, there probably needs to be a bit more structural support and from the government and other incentives to accelerate this process, and particularly the entry cost and where land values are over here. But it still has to overcome obviously the shorter term shock that COVID brought to the student and tourist sector. But aside from that, you know, it's grown. Its growth has accelerated to a certain degree over the past year, and we expect it to do so over the coming years.
Thank you very much, Sasanka. I think that's all the time, all the questions we've got time for. Yes, we're nearly at the hour. So I'd just like to take this chance to thank each of our panelists today for their really insightful and valuable contributions. So a huge thank you to Rosanna, Sasanka, and Young. I really do appreciate you taking the time to provide your input and kind of expertise into a great discussion. I've certainly taken a lot from this, so it's been incredibly helpful to hear you all speak on your individual markets. So thank you again. A reminder that we will publish a recording and a written summary of this webinar online, and do please feel free to share those with your professional networks. And if not too much to ask, please could you just take a few minutes to let us know what you thought of today's session by completing the online poll, which will appear on your screens at the end of the webinar. The Well-Built Environment Forum Global Summit will be visiting Dubai as part of Expo 2020 Dubai. That's taken place in January 2022, and the programme will focus on livable city, so agile, resilient and healthy. And to register your interest to find further details on the programme, please visit the website rics.org/webf. You can follow us on Twitter, Instagram and LinkedIn, where you can receive news of upcoming webinars and catch up on anything that you may have missed. And then finally, you can download the WebF app from the App Store or Google Play, where you can access the latest innovative global thought leadership content across the built environment. So with all that being said, until the next one, goodbye.